Good morning, everyone. Thanks for joining. So we can start the webinar in just 2 minutes. Wait and wait for a few more people to join, and then we can start. So good morning, everyone. Thank you so much for joining today. Today we are going to discuss about why 1 crore is just the starting point for your goal. So before we look at any charts and calculation, I want to start with think back to when you started working or when you were growing up, when you brought about being rich, successful, and completely free from worries, money worries. What was the exact target you had in mind? So for almost every middle class family in India, the target was a single number, 1 crore rupees. Reaching 1 crore was always treated as the ultimate finish line. So you were told about if you could somehow save this amount, you would enter a zone of total safety. You would quit a stressful job or live comfortably just off your savings. So handle your child future and never worry about the monthly bills again. So it was the ultimate symbol of the freedom. So, but today we need to be very honest, real and transparent conversation. In the modern world, the number has quietly lost its power. Today, 1 crore is no longer your final destination. In fact, it is just a starting point of your actual financial journey. So, over the next few minutes, we are going to break down exactly why this happened. Look at what money actually buys in today's world, and show you how to look past will calculate exactly what your real goal required for a lifetime security. Let's start. So now let's move away from numbers for a moment and think about real life. We all work hard, save money, and invest with your purpose. But have you ever stopped to ask yourself, where will my savings actually go? So for most of the families, the answer is this more four major goals: a home, child education, healthcare, and retirement. So let's start with home. For many of us, buying a house is one of our biggest dreams. But today, if you are looking for a decent 2 or 3 BHK apartment in a good location, especially in or around a major city, it can easily cost 1 crore or even more. So, and that's before you include the registration charges and other expenses. So, a large part of your savings would go towards just or just having a one goal. So now let's look at the education. So every parent wants to give their child the best opportunities, whether it's a professional course in India or higher studies abroad. So education costs have increased significantly over the years. For many families, one major educational goal can cost up to 50 lakh to sometimes 1 crore. So the third one is healthcare. So none of us likes to think about medical emergency, but they are a reality. So while health insurance provide valuable protection, there can still be expenses that aren't fully covered. A serious illness or prolonged treatment can put a significant strain on our savings. So finally, let's talk about retirement. This is often the biggest financial goal of all. Imagine retiring at 60 and living for another 25 or 30 years. During those years, you still have monthly expense, healthcare costs, travel plans, and the lifestyle you want to enjoy. A single 1 crore corpus may not be enough to support all these years comfortably. So, especially when inflation continues to increase the cost of living. So now a very logical question comes up. Why is this happening? Why does money loses its value so quickly? The answer is invisible force that we all know exists but completely ignored in our long-term planning. That is inflation. So if you look closely at the chart on this slide, it shows a very common relatable example. Imagine a normal family today that spends exactly 1 lakh rupee every month. It covers home rent or loan repayments, school fee for the kids, grocery or utility bills or fuel for the vehicle, so some weekend outings, so etc. Like that. Now let's fast for 10 years into the future. Let's assume a very normal average inflation rate of just 6% per year in 10 years. Your family will not be living in bigger life. You won't be living in a place or driving a luxury sports car to buy the exact same basket of grocery, to fill the same tank of fuel, and to maintain the exact same quality of light. Your monthly requirement will climb from 1 lakh to 1.8 lakh rupee. So if you step again and 20 years from that exact same lifestyle will now cost you 3.2 lakhs. So every single month, and by the time we look 30 years years out, when you are fully retired and relying entirely on your accumulated wealth, your monthly household bill for the exact same lifestyle will hit a 5.7 lakh rupees per month. So this is the core reality every investor should understand. The silent killer of wealth is not stock markets ups and down. It is the shrinkage of our money's buying power. If your investment strategy only aims for a fixed target like 1 crore without accounting for this, you will end up short of money when you actually need it. So we have to design our plans so that grow faster than this inflation. So when we design a real financial plan, we have to understand the four dynamic forces that dictate how our financial lives unfold over time. The first thing is, as we saw, it's inflation. So think of inflation as a permanent drop in the value of your savings. If your money is sitting in a traditional savings account or a FD with low return, the real world prices are rising faster. So your money is growing, it's actually shrinking or staying idle every year. So the second important thing is time horizon. This means your big goals like child's marriage or your retirement are sitting 10, 15 or 12 years away. While that gives you a time to save, it also gives inflation more time to multiply the future cost of this goal. So the next one is longevity. So it's actually a good thing, but in fact we are living longer, healthier lives thanks to our modern healthcare. People are living much longer than the previous generations. Today, yeah, professional retiring at 60 can easily expect to live till 85 or sometimes 90. So that means your retirement fund has to support your 25 to 30 years away goal. So you might spend the same amount of time spending money in the retirement as you did earning money during your career. So the next thing is lifestyle upgrades. So our definition of a basic life has upgraded over time. Think back 15 years ago. So high speed internet or multiple streaming applications, smart modes for every family member, and annual family holidays were considered luxuries. Today, they are the standard everyday expectation. So our baseline lifestyle has permanently shifted upward. So when you combine these four things, like shrinking money value, long timelines, longer lives, and rising life standards, you see immediately why the 1 crore benchmark is isn't enough for our life goals. So now that we look at the some of the things are changing our money, so we might be asking ourselves, how do I make sense all of this for my own family? How do I actually sit down and calculate what I need without getting confused? So to give you complete clarity, I want to share a simple 5 step formula. You don't need to be a genius or a financial expert to use this. It is a stage change. So first, your goal leads to a cost, which leads to time, which leads to inflation, and finally your investment plan. So let walk through these 5 steps together. So first one, number one is define your goal. You cannot hit your target you cannot see. So don't just say I want to save money. You need to give the money a job and name the bucket. Are you saving for your young child's college degree? Are you saving to buy a larger house in a specific neighborhood? Or are you building your lifelong retirement bucket? Give every single bucket a clear and a target specific goal. And step number two is estimates today's cost. So this is where many of us make mistake. They look 10 or 15, 20 years into the future and just guess a random number. So don't do that. Just ask a simple question. If I had to pay for this goal this today, how much cash would I need? If your child is entering college today, what is the current fee? If you are buying a house today, what is the current market price? So always start with today's real price. So number three is decide the timeline. Look at the exact gap between today and the day you need the money. If your child is 5 years old today, you have exactly 13 years before the walk into college. So if you are 30, if you are 35 today and want to stop working at 60, you have a clear 25-year count time. So count the exact number of years you have left to prepare. So fourth one is inflation. So this is the critical step. So you take the price from step two, look at the years from step three. So look at the and add the rising cost of living as we saw earlier. Normal inflation rate will double or triple the price of your goals over a 10 to 20 year period. So you must calculate the future price of the goal, not today's price. So step number five is building your inflation plan. Once you know the future price and how many years you have left, you work backward. You calculate exactly how much money you need to put away every single month into a growth to smoothly reach that future target without stressing your budget. So now look at the remainder box on side of the slide. If you take only one lesson take away from today's discussion. Don't start your financial journey with a fixed random number in mind. So I just don't say like I just want to eat 1 crore or I just want to eat 2 crores. Those fixed numbers mean nothing in the real world because the value shrinks every day. So start with your real family goals. Run them through these steps and look at actual numbers to guide your investment. So now let's take all these concepts and look at some real numbers. So let's look at this table. So which maps out the typical major family milestones. This is let's say if you look at the first row, child's higher education. Suppose you have a child today and you want to ensure that they can get a quality professional degree. If the degree cost say 25 lakh rupees in today's money, and your child is currently 5 to 6 years old, you have 12 years before they enter college. So now education cost in India climbed but around 10% year due to the high institutional fees. So look at the future cost column. The 25 lakh gold stands into a around 78 lakh rupees by the time your child walk through the university. So second thing is child's dream marriage. So a wedding celebration that costs 30 lakhs rupees today, when adjusted for normal inflation over a 15-year timeline, that transform into a around 72 lakh rupees requirement. So next third thing is your dream home. If you plan to buy or upgrade to an apartment that is valued around 1.2 crore today, and you decide to save cash over the next 10 years to avoid heavy debt, that exact same property profile will go up to 2 crore around. So when you're ready to purchase. And then finally, look at our retirement fund. If you calculate a basic lifestyle of 60,000 rupees a month in today's values, and you have a 25 years left of active work, the total amount of money required to sustain that post-retirement scales to a massive 2.5 lakh per month. So when you sit down with a plain piece of paper and add up these real milestones, the truth becomes clear. Your real life goals are not small, and they are certainly not contained within a single row. But don't let this number panic. So seeing the real destination is the first step to so building our lifelong achievement. So now we know the massive size of our long-term goals. We need a clear blueprint to build our savings without taking unnecessary risk. So a common mistake many of us makes is treating their money like one single goal. So you have to keep all their cash in their bank account or they invest everything into one volatile asset. So to build true wealth, we must divide our money into the three distinct pillars based on when you need it. Let's look at this three things. First thing is emergency fund. So think of this as our financial insurance policy. Life is unpredictable, so we may lose jobs, some big expense like unexpected home repairs arrive out of nowhere. So before you invest a single rupee for the long term, we must set up our production. So your goal is to calculate your exact monthly survival cost like rent, groceries, our basic bills, and keep 6 to 12 months of our savings cash entirely in a safe investment. So this money should never be invested in like high risk investment like equity or locked up in some long-term property. It needs to be in your highly liquid assets, which simply mean like a safe bank accounts or your plain saving tools where you can withdraw the cash in a day or in within our kind of thing. So this money is not there to earn high return. It is there to give you peace of mind. So you never have to touch your long-term investments during that time of crisis. So second pillar is your short-term goals. There are the milestones, you are coming up very soon, anywhere from tomorrow up to the next 3 years. This could be saving for your family holiday or for next summer, or putting some money for your car upgrade or purchase of next year, or preparing for your child's school admission fees. So because you need this money very soon, you cannot afford to take high risk with it. So if let's say if stock market drops tomorrow, you don't want your holiday plan or your car savings to uh, down by 12%. So for these short-term targets, you must use relatively stable investment. Think of like simple traditional accounts or a short-term liquid funds. So the third pillar is our long-term goals. So these are your big milestones that are 3 or more years away, like your long-term retirement fund or child's education, and child's marriage kind of. So this is where our strategy changes completely. For long-term goals, our biggest enemy is not short-term market volatility. It is the silent rise in the prices that we looked at earlier through inflation. If you keep your 20-year retirement in your basic bank account, inflation will slowly eat away its value. So to protect your future, we must invest the specific bucket for high growth. This means putting your money into asset like say mutual funds where you own a small piece of growing business over a long period of time. This growth assets allow your money to compound, which means your profit earn their own profits and multiplying your wealth over time. This is the only way to stay ahead of the rising cost of living and reach those multi-growth targets comfortably. So when you organize your wealth the way we achieve the total balance, you have cash ready for today emergencies, of safety for tomorrow short-term plans, and a powerful growth engine that will build your long-term future. So let's look at exactly how much difference it makes to your daily pocket when you put this long-term growth engine to work as early as possible. So the secret to building a large fund for your retirement or a family goals doesn't require sometimes a massive salary hike kind of things. It requires a deep understanding of your fundamental law of nature, the compounding power over time. So look carefully at the horizontal bars on this. This is if you look at, let's assume your target is to build a substantial total wealth of base of 5 crore rupees by the time you reach the age of 60. So we will assume you invest your money systematically in a long-term growth portfolio like equity mutual funds. So that delivers a realistic average growth rate of 12% per year. So let's look at the first one. If you are an early starter who begins at the age 25, you have a long 35 years runway ahead of you. So because your money has over three decades to quietly multiply, grow upon itself. Do you know how much you need to set aside every month via a monthly investment plan to hit the 5 crore target? So if you invest 7,800 odd per month, that's a small amount that most of us can easily manage. So never look at what happens if you delay. Let's say you wait just 10 years and start at age 35. So you have 25 years left to grow because you lost this first 10 years. You required monthly investment amount have to little bit higher. So you now have to invest something around 26,000 rupees every single month to hit the same destination. So if wait until age 45 with 15 years to love to grow, the number get more higher. So you invest 1 lakh rupees every single month, and if you delay your financial plan until age 50, it's just 10 years left. So you have to invest around 2 lakhs to 2.15 lakhs per month to achieve this target. So time does the heavy lifting for in our pocket. So does it have to? So this single most expensive mistake you can make as an investor is simply waiting or postponing our investment can cause our compounding effort. So we have to increase our saving also over the period of time. So throughout the today's session, we have spoken about why 1 crore is no longer the financial decision, but reaching your first crore is still an incredibly important milestone because it represents years of discipline and consistency. So the good news is that it doesn't require extraordinary income or taking excessive risk. It requires a structured plan. So let's look at simple example. Imagine you start investing 10,000 per month. So as your career progresses and your income grows, you will gradually increase your monthly investments. Maybe maybe after a couple of years, it's 15,000, then 20,000, and so on. These are in a drastic, they are small and manageable steps that grow along with your earning capacity. Over time, those small increases make a significant difference. You can see how the accumulated savings steadily build from 1.2 lakh in the first year to 12 lakh in the 5 years, and 33 lakh by the 8 year, and eventually 1 crore. So the important lesson here is in that exact number. It is the habit behind them. So wealth is created by waiting for the perfect investment or trying to time the market. It is created by three simple principles. So invest consistently, increase your investments as your income grows. So stay invested for the long term. That's the process we believe in. So most of us only celebrate one day, that day we achieve 1 crore, but we believe wealth creation is made up of many important victories. That's why we have broken the journey into meaningful milestones. Your first 2 lakhs, then 5 lakhs, 10 lakhs, 25 lakhs, 50 lakhs, and then finally 1 crore, and even more. So every milestone represents something big, something much more valuable than a number. The guide, if you build the habit of reaching 2 lakh, building a habit of reaching 2 lakhs, you are developing the discipline need to reach 5 lakhs. So once you have crossed the 10 lakhs, you are no longer wondering if investing works. You are experienced the power of consistency. So every milestone strengthens your confidence and keep your focus on the bigger picture instead of short-term market movement. So that's exactly why we call ourselves in M2W, because wealth isn't built in overnight. It's built one milestone at a time. By the time investor reaches the first goal, so they already developed the habits of discipline and mindset need to build even greater wealth in the years ahead. That's why for us, one crore is in the finish line. It is simply another milestone in a much larger journey. So I just give you some brief about M2W. So M2W is a milestone. It was founded on a simple belief. So financial success shouldn't depend on luck or market timing. It should be built through a disciplined, goal-based investment process. Mainly, it is started in the idea of small investors have to think big. For the last 16 years, we have been helping investors move beyond chasing a single number and instead focus on achieving the goals that truly matter. So today we are privileged to manage over 1,050 crores in assets and work with more than 8,500 clients. So these numbers can reflect the trust our clients have placed in us, or what truly defined is our approach. We don't begin with products. We begin with the people. We start by understanding what our clients want to achieve, whether it's a retirement or child's education or buying a home or a financial independence or creating a legacy for the next generation. So from there, we build a personalized roadmap that aligns their investments with those goals. So we guide them through markets up and down, review their progress regularly, and help them stay focused on the long-term goal. So because if you know success investing, it's about not reacting to the every headlines going around us. It's about following a structured, disciplined process year after year. So that's exactly what we have been doing this for the past 16 years. So our goal is it's not simply to help clients to reach one goal, it's to help them build enough wealth to live the life they want to in the long term. So, as we bring this presentation to a close, I want to leave with you a clear, stress-free, actionable plan that you can begin to implement. So, building a true financial freedom isn't about luck; it is about a simple, disciplined process. So, step one is target your real future cost first. So, I want you to completely chasing the number like so 1 crore just because it sounds good. So, sit down and analyze. So, list out your actual life milestones, your home, your child's education and your retirement lifestyles and calculate what those goals will actually cost on the day they arrive. So step two is match your investments to your timeline. So don't treat your wealth as one bucket. So money needed in the next 2 or 3 years should never be exposed to the ups and downs of the stock market. So keep it in safe and low risk options. But money allocated for goals that are 10 or 25 years away, like your retirement fund, must be invested heavily in growth assets like equity. So that's the only thing which help us to beat the inflation. So next thing is increase your savings annually. When you see a target like 26,000 rupee a month on HR, don't worry if you can only afford a 10,000 today. The secret is to start with whatever amount your budget allows right now and make a firm commitment that increase your monthly investment by 10% or 15% every single year as your income grows. So a small investment that steps up every year will easily capture a massive target. So finally, step four is building a strong financial safety net. Before you invest a single rupee into the high growth assets like equity, we must protect your baseline. Ensure you have a good personal health insurance policy for your entire family and your like another term or any other insurance that covers your income. So this safety net ensure that if life throws an unexpected medical or personal emergency for you, your long-term investment plans that remains completely untouched and perfectly on track. So if you see true financial freedom is maybe naturally it's a result of our clear goals and a long time and the discipline to start early as possible. And take the first step today. Let the time work the magic for you and build a secure, worry-free future for the people you love most. So yeah, that's it from my side. Thank you very much. We will meet you in next webinar. Thanks.